Welcome to vTalkInsight, Market Drivers Daily for August 21st, 2026. AI capital spending, bond yields, and geopolitics are pulling in the same direction today, tightening financial conditions just as energy markets heat up again. Let's start with the AI boom, where debt and equity are now openly competing for the same growth story. The AI story has shifted from a narrow tech rally to a full cross-asset cycle, with capital flowing through equity, credit, and even macro rates. Strong investment returns still justify accelerating AI Capex for now, but the bar for new projects is climbing as investors question how long earnings growth and margin expansion can run at this pace. Compared with earlier this week, when the focus was mainly on headline growth, today the spotlight is firmly on how this boom is funded and what it does to the cost of capital. On the funding side, AI borrowers are tapping markets aggressively. Broadcom is negotiating to raise around $60 billion in new debt, with talk it could go as high as $100 billion, using structures that keep much of the exposure off balance sheet while still guaranteeing parts of the risk. Across the sector, yields on AI-related debt in the 7 to 8% range are drawing in capital, offering equity-like returns with bond-like seniority and potentially capping upside for some AI stocks. At the same time, a surge in AI and telecom investment-grade issuance, forecast in the hundreds of billions of dollars, reinforces the sense that this theme is now a major competitor to sovereigns for global savings. Fundamentals remain powerful, but the leadership mix is evolving. NVIDIA is expected to post revenue and profit growth close to 100% year-over-year, extending an exceptional run of AI-driven earnings, while management has already guided to robust demand into next year. Memory players such as Samsung and SK Hynix are generating substantial free cash flow from AI-driven demand and have pledged to return roughly half of that cash, with Samsung alone planning tens of billions of dollars in payouts. At the same time, investors are increasingly looking beyond hyperscalers to beneficiaries of AI adoption, including mid-cap industrials tied to automation and reshoring, emerging markets with improving earnings, and private names like Anthropic preparing for a mega IPO that could rival some of the largest tech listings on record. Against that strength, questions are building about sustainability. Several analyses flag that keeping AI Capex growth at current rates will be challenging by around 2027, raising doubts over how long earnings and margins can compound at today's clip. Within the supply chain, chip and memory shortages are easing faster than expected. The new constraint is power, with AI data centers projected to need at least 150 gigawatts of extra capacity over the next 5 years, implying roughly $5 trillion of associated investment. Power availability is becoming the bottleneck, just as political resistance, environmental concerns, and community pushback intensify around new data centers, creating a tension between the scale of the build-out and the social license to operate. Public sentiment toward AI is also turning more complex. Brands and politicians are leaning into anti-AI messaging. Worries about job losses and resource use are climbing, and that may slow adoption in some segments, even as corporate capex remains elevated. Within markets, investors are starting to rotate from mega-cap platforms into newer AI leaders like Anthropic and into downstream beneficiaries such as software and biotech, a shift that can raise volatility for the established names. The key watch points now are NVIDIA's upcoming earnings, the size and pricing of Broadcom's debt package, the timing and valuation of major AI IPOs, and early signals from the power build-out. Together, they will show whether AI continues to absorb capital smoothly or whether funding strain and infrastructure bottlenecks start to spill over into broader risk assets, which matters even more once we fold in the geopolitical and energy backdrop. Geopolitics and energy are increasingly the bridge between regional shocks and global macro pricing. The United States is preparing one of its most coordinated efforts yet to isolate Iran economically, including potential secondary sanctions on countries still trading with Tehran, with China singled out as the key buyer of Iranian oil. This raises the stakes for both global trade and the wider U.S.-China relationship, especially around an already sensitive diplomatic calendar. Assessments of how much these moves will hit oil flows are divided. On one hand, Iran is already under heavy sanctions, and some analysis suggests additional steps may not drastically change its economic activity or exports, particularly given its track record of working around restrictions. On the other hand, Ship tracking data indicates supplies available to Chinese customers are being squeezed, while Gulf states, such as Abu Dhabi, are playing a bigger role in constraining Iran's regional economic reach. What seems clearer is that sanctions are limiting Iran's ability to fund proxies and are feeding a long, grinding confrontation that keeps a risk premium embedded in energy markets. That premium is amplified by conditions on the water. Maritime traffic through the Strait of Hormuz has dropped to extremely low levels, with only a handful of ships still making the passage amid ongoing conflict and security threats, leaving about 6,000 seafarers and hundreds of vessels stranded in the Gulf. There is still no independent confirmation that minefields have been cleared, undermining official claims of safe navigation and keeping insurance and freight costs elevated. As a result, trade is being diverted onto alternative routes by road and rail, disrupting existing supply chains and increasing transport costs at a time when diesel and jet fuel prices are already under pressure. Refined products are where the stress is most acute. Attacks on refineries in the Middle East and Ukraine, combined with disruptions to Russian refining capacity and an export ban on diesel, have left global refining systems running near their limits, even though total throughput is down around 8% year-on-year. Diesel and jet fuel prices have spiked toward $200 per barrel, with diesel margins running at roughly 5 times normal levels, pushing up logistics, agriculture, and industrial costs worldwide. In Europe, natural gas prices are at 5-month highs with storage at record lows and gas and power benchmarks up sharply from recent weeks, while Germany's energy-intensive industrial base is suffering layoffs, stagnation, and a loss of export strength. Crude itself sits at the center of this complex. Brent in the mid-90s is increasingly seen as a base case given ongoing outages and constrained refining, and some forecasts point to a move above $100 per barrel later this year if Middle East tensions escalate further. Higher oil has already helped push one-year inflation expectations up and contributed to a roughly 60 basis point jump in 30-year yields, while the correlation between bond yields and oil prices is approaching record highs. European equities have been weighed down by this energy squeeze, in contrast to the United States, where AI-led growth remains the dominant narrative, underscoring a widening regional divergence in market drivers. How these energy and geopolitical pressures feed back into already fragile bond markets is the next key question. Long-duration yields remain the central macro anchor, and they are still uncomfortably high. After climbing back above 5% earlier this week, 30-year Treasuries are now around 5.24%, levels that raise questions about the sustainability of housing valuations and equity multiples. Nominal GDP growth running between 6 and 12% year-over-year, supported in part by the AI boom, reinforces the idea that the neutral rate has shifted higher, while persistent deficits and sticky inflation argue for a higher-for-longer rate regime. Fiscal dynamics continue to do much of the work. U.S. debt has pushed beyond $40 trillion. Interest costs are eating a growing share of federal revenues, and the deficit remains large even after some improvement versus last year. The Treasury Secretary has signaled readiness to expand long-term buybacks and adjust issuance, but market participants remain skeptical that modest tweaks can offset structural deficits and heavy supply. There is concern that refinancing low-coupon debt through buybacks at today's higher yields could actually worsen long-run funding costs, especially given the growing reliance on short-term bills that carry significant rollover risk. Competition for capital from the private sector is intensifying the pressure. AI and telecom issuers are expected to place roughly $540 billion of investment-grade bonds, while flagship deals like Broadcom's $60 to $100 billion funding plan add substantial duration to the market. Yields of 7 to 8% on some AI-related corporate debt are increasingly attractive relative to equities, just as corporate reshoring, supply chain rewiring, and the planned 150 gigawatts of AI power capacity all demand heavy upfront financing. This combination of sovereign and corporate supply is pushing term premia higher and has even spilled into other markets, with 40-year Japanese government bond yields moving up sharply. Asset allocation is already reacting to this backdrop. With higher yields available in fixed income, equities are facing tougher competition for capital, particularly momentum-driven segments that are vulnerable to sudden rate spikes. Some flows are rotating toward quality stocks in technology, communications, consumer staples, and utilities, while others are moving into gold and even Bitcoin as investors hedge against policy uncertainty and duration risk. Yet a counterview argues that much of the recent bond weakness reflects sentiment rather than fundamentals, pointing out that inflation expectations remain anchored. Recent U.S. data have softened, and long-end yields have actually traded within one of the tightest ranges in almost 2 decades despite the noise. Policy uncertainty sits on top of these market forces. Some red Treasuries actions and already elevated yields as taking pressure off the Federal Reserve to hike again, while others warn that if financial conditions ease too much as deficits and AI Capex stay high, the Fed may feel compelled to tighten further, raising the risk of a policy mistake or even a self-reinforcing doom loop at the front end of the curve. Upcoming PCE inflation data, influenced by rebounding energy prices and refinery constraints, will be critical for that debate. So will details of the next refunding announcement, the scale and uptake of AI-related bond deals and IPOs, and how 30-year yields behave around current levels. Together, these signals will show whether the market can settle into a high but stable yield range, or whether another leg higher forces a broader repricing across equities, credit, and housing. To sum up, the AI Capex wave is still powering earnings and deal flow, but it is now a direct competitor to both Treasuries and equities for scarce capital, especially as power bottlenecks and political pushback emerge. At the same time, geopolitical tensions around Iran, the Strait of Hormuz, and Europe's energy system are tightening fuel and gas markets, keeping inflation and growth risks skewed to the upside. Overlay that with long-end yields near multi-decade highs, persistent fiscal deficits, and record corporate issuance, and the result is a higher for longer rates regime that leaves little margin for policy or geopolitical error. Watch upcoming AI earnings and IPOs, U.S. inflation data, Treasury issuance plans, and any escalation in energy disruptions as the key markers for cross-asset pricing in the weeks ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.